A very good evening to all of you students. My name is C.A. Devas Gupta and today we will be continuing on the topic of working capital. So good evening Komal, Kiran. I can see you have joined and rest others also who are in the process of joining. Yes, Kiran. Okay. So let us start. In our previous session, students, we have discussed about some of the basics of work management of working capital, right? In which we first of all understood that what is the meaning of working capital, then what is the meaning of a current asset or a current liability, right? Then what is the right working capital split for a company? Is negative working capital good or bad, or is higher working capital good or bad? And along with that, we did some of the questions. In today's session, we will be further doing some of the questions that has appeared in the recent RTP of May 2024 attempt. So let me quickly go to the RTP. So question number one, which is on a case scenario based question. Okay, we will just first do that. So it is on working capital. It says that Armor LLP is a newly established startup dealing in manufacture of a revolutionary product, HDHMR. This is the product name, which is a substitute to conventional wood and plywood. Okay, so they are saying it's a substitute of conventional wood and plywood. Good evening, Sweetie Kumari. Good evening, Sushil Kumar Barek. Good evening. It is an economical substitute for manufacture of furniture and home furnishing. Okay. It has been asked by a venture capitalists. Now, who are venture capitalists? Does anyone knows who are venture capitalists? Or anyone wants to try and attempt this? Generally, venture capitalists we call whom? Yes, Sushil. So since this question is from May 2024 revision test paper. This is a RTP for May 2024. Okay. Yes, come on. You can respond either on Zoom, yeah, or on the other chat. So Sweetie has responded. Investors who put money for some special purpose. Okay. Have you heard the term called private equity? So in a way, there are two equities, right? One is public equity, which is invested by the public at large, and second one is private equity, which is invested by a specific individual in a specific company, and it is privately done, right? So public equity is wherein all the people at large will apply for the equity of that particular company and they will get allotments, right? So the private equity is something that is specific to a company. Now, venture capitalists are part of the private equity firm. So, what they do, they generally invest, they generally see some worth behind the idea that the startup is following. And once they see that this idea will take ahead, then they will start investing. They will also contribute in terms of the daily decision making, and once they feel that the company has now reached to a particular stage, then they will sell off or they will divest their investments. Okay, so venture capitalist is someone who will invest, who will also make sure that the company is running in a proper manner, and then once the valuation reaches to certain level, they will divest and they will book the gains. It has been asked by venture capitalists for an estimated amount of funds required for setting up plant and also the amount of circulating capital required. Okay. Uh, okay. Clear? Since venture capitalist is in the business of investing, It is asking that how much investment is needed by the startup, maybe in the form of capital expenditure or in the form of working capital, right? A consultant hired by the entity has advised that the cost of setting up the plant would be rupees 5 crores. So they have clearly told that cost of setting up the plant is rupees 5 crores and it will require 1 year to make the plant operational. The anticipated revenue and associated cost number are as follows. Okay. Units to be sold 3 lakhs square meters per annum. Now, see, they are into the business of HDHMR, which is a substitute to the wood and plywood. So, whatever product they are selling that has a basic unit of measurement as square meters. Okay, this has a basic unit of measurement as square meters. So, they are planning to sell 3 lakh square meters per annum. Sale price for each square meter is 1000. Okay, so 1000 into 3 lakh square meters per annum will be their overall sales, correct? Raw material cost they have given us as 200 per square meter, which is fine. Labor cost is rupees 50 per hour. Okay, but how many hours we need to manufacture 1 square meter is 3 hours. So labor hours per square meter is 3 hours. So in totality, 3 hours for 50 rupees is 150 rupees is the labor cost, correct? So these calculations we are just triggering in our mind. Sorry. Then comes cash manufacturing overheads, rupees 75 per machine hour. Machine hours per square meter is equal to 2 hours. So machine hours it is taking 2, but labor it is taking 3 hours. So the labor cost will come through labor and machine hours will come through machine. Machine cost will come through machine hours. Or let's say the manufacturing overheads, I mean to say. So the manufacturing overheads will come through machine hours. Selling and credit administration overheads, they are saying 250 rupees per square meter that has been taken as an allocation. Being a new product in the industry, the firm will have to give a longer credit period of 3 months to its customers. Okay. It will maintain a stock of raw material equal to 15% of annual consumption. Now, see, from here, the working capital related specific points are starting. Since it is a new product, so they are saying the firm will have to give a longer credit period of 3 months. So the credit period is 3 months. It will also maintain a stock of raw material equal to 15% of annual consumption. That is clear. Based on a negotiation with creditor, the payment period has been agreed to be 1 month from the date of purchase. Now, see, we are giving credit for 3 months, but we are getting credit of only 1 month, correct? The entity will hold finished goods equal to 2 months of units to be sold. Now, RM, how much they are keeping? 15% of annual consumption. Finished goods, how much they are keeping? 2 months of units to be sold. Okay. All other expenses are to be paid 1 month in arrears, whether it is labor cost or whether it is overhead cost. Both of them are being paid in 1 month arrears. Cash and bank balances to the tune of rupees 25 lakhs is required to be maintained. So they have given us a limit of 25 lakhs of cash and bank balance to be maintained. The entity is also considering reducing the working capital requirement by either of the two options. So now they are also evaluating at the same time how can they reduce the working capital. And for that there are two options. A, reducing the credit period to customers by a month, which will lead to reduction in sales by 5%. Okay, so what they're saying is if they want they can reduce the credit period by 1 month, but in that case there is a sales loss of 5%, because if you give credit then there are high chances you will clock higher sales, but if you don't give credit the sales will become lower. Engaging, and the B part is engaging with a factor for managing the receivables who will charge a commission of 2% of the invoice value and will also advance 60% of the receivables at the rate of 12% per annum. So what this factor will be doing, this factor will be charging 2% commission on the invoice value, and that factor will also give the company around 65% against that receivable as an advance at the rate of 12% per annum. This will lead to the savings in administration and bad debt cost to the extent of 20 lakhs and 16 lakhs respectively. Now the moment you enter into this idea of having this factor, then you will be able to save 20 lakhs and 16 lakhs respectively. The entity is also considering funding a part of working capital by bank loan. For this purpose, bank has stipulated that it will grant 75% of the net current assets as advance against working capital. Now, see, the language is bigger. However, the useful thing that we are have to going to extract from this is lesser. So, in this, we can make it out that bank will give 75% of net current assets as loan to us. The bank has quoted 16.5% rate of interest with the condition of opening a current account with it, which will require 10% of loan amount to be minimum average balance. Okay. You, being a finance manager, has been asked the following questions. So it's a very big question, right? But it's good because it will help us in getting to lot of parts. So the first one, the anticipated profit before tax per annum after the plant is operational is how much that they are asking us. So first of all, it's a simple calculation of the anticipated profits, right? It has nothing to do with the working capital, right, students? So let's start. So we are talking about question number one. This is RTP May 2024. Okay. So we are talking about part A, right? So we have been given the details. So let's plot it in the statement, right? So first of all, let us start with the raw material. We will start with the inventory, then we will go to the after putting the inventory details, then we will go to the sales and then profit, right? By inventory, I mean cost of goods sold from the P&L perspective, right? So raw material consumption. Now here there is one catch. Can any one of you tell me actual raw material will be consumed for how many units, whether 3 lakh or whether something else, or if something else, then how much? So we have read the question, right? In this, I'm talking about the raw material consumption for producing the FG, right? So for selling 3 lakh square meters per annum, do I need to manufacture 3 lakh units per annum or something else? Question has indicated you. I request everyone to please go through and respond. Is the Zoom chat not on for you, all of you students, to respond? Because I'm not getting any response on Zoom chat. Yes, come on. Okay, I have asked this question that for producing, or let's say for selling 3 lakh units, do we need to, sorry. So producing, for selling 3 lakh units, how much we need to produce? Come on, tell me. Technically, can you check once? I think the chat is not opened. The Zoom chat. Very good, sweetie. I have got the response from sweetie. So, as the question suggests, for FG, they have said that they will maintain another 2 months of inventory, right? So, in a way, for selling 3 lakhs, they will have to do the production of 3 lakh for 12 months and for another 2 months, right? So, let me go back. So, raw material, we are talking about consumption here. So if 3 lakh is for 12 months, 14 months it will be how much? 3 lakh divided by 12 into 14. So this will be 3 lakh 50,000 units. Okay. So for 3 lakh 50,000 units at the rate of 200, we will end up spending on the raw material. So this becomes around 7 crore. Exactly 7 crore. This is our raw material consumption. Then on labor cost, since we are producing for 3,50,000 units, the labor cost will also get incurred for 3,50,000 units at the rate 150, right? How this 150 has been arrived? Um, 3 hours and 50 rupees per hour. If you see in RTP, the labor hours is 3 and labor cost is 50 rupees per hour. So simply 3 into 50. So this becomes 150, right? So 350 into 150, it is around 5 crore 25 lakhs. Clear? Then, apart from labor, in the question we also have production overheads, the cash production overheads that they have mentioned. Again, we will incur this for 3,50,000, but for this, the rate will be multiplied by the machine hour rate. Okay? So that also comes to 150, correct? Because if we see what are the details given, 75 into 2. So similarly 5 crore 25 lakhs. Okay. So the total cost of production through this comes out to be, this comes out to be 17 crore 50 lakhs. Okay, students, I hope this is clear. Now, since we are talking about P&L, we are only concerned with what we are selling. So we will reduce the FG stock. Okay, that is around 50,000 units, and 50,000 units for, okay, let us calculate the per unit rate here. 200 plus 150 plus 150, this is 500, correct? So 50,000 units at the rate of 500, this comes to 2 crore 50 lakhs. Clear? And hence our COGS, which is cost of goods sold, becomes for 3 lakh units at the rate of 500 with 15 crore in the costing. Okay. Now we will also add our selling and administration expenses. Selling and admin expenses again for 3 lakh units. Now here the question is not coming of 350 or 3. Why? Because the selling and administration will always be incurred on what you are selling on and on not what you are producing. Clear? So here what we will do, we will just take selling and administration expenses as on 3 lakh units. What was the rate? The rate was 250. This becomes 7 crore 50 lakhs. Okay, and hence the overall cost of sales I can say is 22 crore 50 lakhs. Now how much sales are we going to drive from this? On 3 lakh units we are going to drive 1000 rupees, correct? How this 1000 has come? That is given in the question as facts, right? So we will realize sale price for each square meter is 1000. Units to be sold is 3 lakh. So hence it will become 3. 3 lakhs into 1000 is 30 crores. So, okay. And hence our profit becomes on a cost of sale per unit basis it is 750, right? So profit becomes on a per unit basis as 250 and at an overall level it becomes 7 crore 50 lakhs. Clear? Yes, Shambhavi. It is 3 lakhs. No, Shambhavi, you would have responded to my earlier question. It was 3 lakh plus 12 into, sorry, divided by 12 into 14. Okay. Clear, students? Now, so the first part, it's coming out to be 750 lakhs. This is a big question, so we will solve it after understanding it properly because once it is done, it will help you in, you know, getting to lot of, let's say, understanding. So the for the first part, A is the right answer, 750 lakhs. Now the second part, the estimated current assets requirement in the first year of the operation when debtors is calculated at cost. Okay, just please remember debtors they want us to calculate at cost and they're asking us to calculate the estimated current assets requirement. So as of now, they're not asking us to calculate the current liabilities. Okay. Now, for current assets, we have come to the second part. For current assets, we have to break it down. Inventories, within inventories, we will have to start with the stock of raw material. Now, if you see, we have said that stock of raw material will be kept at the rate of 15% of the annual consumption. What is the annual consumption? Come on, students, tell me what is the annual consumption? is, do we take annual consumption on FG sold or FG produced? Because these questions will come to all of you in your mind, right? So hence I'm asking whether you will take from the point of view of annual consumption as 3,50,000 units or 3 lakh units for RM. Yes, students. 350, very good. Shambhavi Kiran, Bhumika, yes, very good. You will take on 350 because your consumption is on the FG produced, not on the FG sold. Okay. So 15% on 7 crore. This becomes 1 crore 5 lakh. And stocks of finished goods. So stock of finished goods at cost level we have to take, right? From here, can we understand how much it will be? Stock of finished goods is actually 2,50,000, right? So we will take that. Sorry, this is 2 crore 50 lakhs. This is the stock of finished goods. Then debtors and cash and bank balance. Now cash and bank balance it's straight away given 25 lakhs. Now debtors, since they have said to calculate it at a, yes, Pranjali, your answer was correct. Pranjali Majumdar, your answer was correct. Now, what I'm saying is, debtors they have calculated, they have asked us to calculate on a cash basis. So, for 30 crores of debtors, this one, the cash cost, or let's say the cost of these debtors is around 22 crore 50 lakhs. So, we will take debtors of 22 crore 50 lakhs as per annum. And how many months of credit have we allowed it to them? For 3 months credit we have allowed to them. So 22 crore 50 into 3 divided by 12. So this becomes 5 crore 62 lakh 50,000. And we have to add all of this to arrive at the total current assets. 942,50,000. 9 crore 42 lakh 50,000. Okay. Clear? Now the third part. So second part A is the right answer. Okay, 9 crore 42 lakh 50,000. The third part, the net working capital requirement for the first year of operation is. Now they are asking us to calculate the net working capital requirement. So now we have to calculate the current liabilities value. Correct? Current assets we have already calculated. Current liability we will calculate, and then we will arrive at the net working capital requirement. So from above we can use total current assets as 9 crore 42 lakh 50,000. Then total current liabilities in the way of creditors and other expenses payable, right? So creditors will be how much? Now, if you see, 7 crore is what we will consume as raw material, and on top of that, 1 crore 5 lakh is what we will additionally procure as raw material, right? So, hence, our total creditors will be calculated as 8 crore 5 lakhs for 1 month, right? Similarly, on other expenses, we will take labor and overheads, correct? Labor and overheads. Now, overheads we will take both production as well as selling and administration. So, here the total is first of all labor, production, and then selling and administration overhead. So, labor is how much? Labor is 5 crore 25 lakhs. Production is also 5 crore 25 lakhs, and selling and admin is 7 crore 50 lakhs. So if we take a total 5.25 plus 5.25 plus 7.5, this is totaling to 18 crores. Now on this 18 crores, we will take 1 month, right? Because 1 month arrear is what we are using to pay this. So 18 crore divided by 12. So this comes to 1.5 crore. So first of all, the creditors becomes how much? 6708 triple three. This will get reduced, and 1 crore 50 lakhs, which is this, will also get reduced. So this overall in totality becomes 2 crore 17 lakh 08 triple three. No, wait. This is the total of liabilities, so I should put it above. Wait. So the total current liability is 2 crore 17 lakhs 08 33, right? And the breakup is below, and hence the net working capital becomes 7 crore 25 lakh 41 667. So here we can mention, let's say this is A, this is B. So here it is A minus B. Simple. Okay, just for clarification. Clear? So the third part, it comes out to 7 crore 25 lakhs 41 667. So this is the correct answer is C. Okay. Now the fourth part, the annualized percentage cost of two options for reducing the working capital is. So now for whatever is the percentage annualized cost of both the option is what they are asking us to calculate. So let us first evaluate what are these two options. Right now let us go to the fourth part. So there were two options, right? In this A part was the reducing debtors balances, right? Debtors period. So cost for reducing debtors credit period. So the debtors credit period is, as of now, 3 months. So how much is what we are going to make as 2 months? Okay, so the debtors balance will become how much? So the debtors balance, first of all, will have to be calculated taking into account the 95% of sales. Why? Because the moment you opt for this option, your 5% sales will go for a loss, right? You will not be able to sell that. Okay, so it will become into 95%, and this will be for 2 months, right? And what was the cost of these debtors for 3 lakh units? Let's take that. That was around 750. Perfect. So we will multiply it with the 750. Okay. So now if you calculate this, 750 into 3 lakh into 95% into 2 divided by 12 comes out to 3 crore 56 lakh 25,000. I'm writing it here. 3 crore 56 lakhs and 25,000, right? And this we have to compare with the debtors balance of credit period 3 months. So this is what we have done. Credit period 2 months. This is the debtors balance. Now debtors credit period is 3 months. Then debtors balance will be how much? We have calculated above, right? That was on 22 crore 50 lakhs for 3 months. That was 5 crore 62 lakh 50,000. This is where we have calculated this one, 562.50. 5 crore 62 lakh 50,000. So the amount released from debtors, sorry, will become the difference of these two, right? The 5 crore 62 minus 3 crore 56, which is 2 crore 6 lakhs, 25,000. Clear? So now, if this is the amount released, against this, there is a loss of sale that will happen, right? So against that loss of sale, the profit will get reduced. So ideally, we have to take the profit margin as the real loss, correct? So then the reduction in profit, this will happen for 15,000 units, correct? At the rate of 250 rupees. Because here in our previous statement, we came to know that per unit profit is 250. So in totality, there will be a loss of 37 lakh 50,000. Correct? So on a percentage per annum cost, if this is the annual amount released on debtors and this is the incremental cost on account of lower sales, so I will end up So this percentage per annum cost for me will be 37 lakh 50,000 divided by 2 crore 6 lakh 25,000 into 100 simply, which is 18.18%. Clear, students, still here? So the A option, both the comparisons are done till here. I hope the solution is clear till now. Then we will move to the second option. Within the fourth part, now we had second option. What is that second option? To get the services of factor, right? So in terms of cost of factoring, there is a commission. Now this 2% of commission will be on the entire sales value, which is on 30 crores. So 30, this becomes 60 lakhs. Okay, students. Then we also will get advance. On that we will have to pay interest, right? So if, okay, let me start the bracket from a bit further. If 30 crore is the amount, on that 65% will be the advance, on that 12% will be the commission for 3 months at any given point of time, right? So it will become 58 lakh 50,000. And there, apart from this commission and interest, there will be some sort of savings. The savings are how much they were given in the question? 20 lakhs and 16 lakhs respectively. So in totality, 36 lakhs. So 20 lakhs plus 16 lakhs. 36 lakhs is the savings. Now the total will become 60 lakhs is the cost of this commission, right? And 58 lakh 50,000 minus 36 lakhs, 82 lakh 50,000. This will become the cost of factoring. Now, what is the release from debtors? The release from debtors will become 65% of 30 crore, right? Because that will come as an advance. So net cost of factoring will become 82 lakh 50,000 divided by 65% of 30 crores, right? So I'm just mentioning this number here. 82 crore 50 lakhs, sorry, 30 crore into 65%, which is 19 crore 50 lakhs. Now here there is one catch. That catch is that this 1950 is for 3 months, right? And we have to calculate the per annum number. However, in the first part, this amount was a per annum number, right? On a per annum basis, this amount will get released. Or likewise, you can say that this commission, or let's say the cost of factoring is for 3 months. Hence, for making it an annualized number, we will have to take it as into 12 divided by 3, right? So on a percentage per annum cost basis, this will become 8250 divided by 1950 into 12 divided by 3. So 16.92 is the cost that comes from factoring. Okay. So finally, cost of reducing debtors option and cost of factoring. This is 16.92%. Here it was, I think, 18.18%. This one. Clear? So this is the answer. Now let us see from the options that are given to us. So I think the first is the right answer. A part is the right answer. Clear? Now let us come to the last part. What will be the maximum permissible bank finance by the bank and annualized percentage cost of the same? Now they're asking us that what will be the maximum permissible bank finance. So what was given in the question? Okay, so Sweetie is asking, please explain the release from debtors. So the release from debtors, it means that, let's say earlier you have invested an amount of, because you have invested in the amount of debtors as 3 crore. Now, if you ask them that I'm reducing your credit period and your ongoing debtors becomes 2 crore, that means you get a release from debtors, right? Equivalent to 1 crore. Don't, will you not say that 1 crore is now less required in terms of the capital to manage those debtors? The answer is yes. So that is why we call it as the release of debtors. Release from debtors will come once you reduce your debtors amount. Okay. Now the last part, what will be the maximum permissible bank finance by the bank? Now for this, we have to first of all calculate the, what was the condition. Okay, let's go to the condition of the bank finance first of all. I'm reading the last para. The entity is also considering funding a part of working capital by bank loan. For this purpose, bank has stipulated that it will grant 75% of net current assets as advance against working capital. So 75% of the net current assets. And further, there is one more thing. The bank has quoted 16.5 rate of interest with the condition of opening a current account with it, which will require 10% of the loan amount to be minimum average balance in that current account. Okay. So that means we have to fund for that current account. Effectively, bank will give us 75% and it will ask us to retain 10%. So net 65% is what we will get from the loan. Okay. So now let us go back. What is our net working capital, students? Now we are talking about the fifth part here. So the net working capital is equal to 7 crore 25 lakh 41,667, right? This is what we have calculated above in the third part, right? And the maximum permissible bank finance will become 75% of this amount. 7 crore 25 lakh 41,667. Okay, 725 41,667 into 75%. Okay, so this is around 5 crore 44 lakhs 06 250, right? And they've also asked us to calculate what the next part. They've asked us to calculate the what will be the maximum permissible bank finance, which is this amount 75%, and the annualized percentage cost of the same. Now if you see, on 75 they will charge 16 and a half, but effectively we are getting only 65%, right? By 10% they will retain as their own margin. So annual cost of bank loan will be 16.5 percentage divided by 100% minus 10%. Why I'm doing 100%? Because the 16.5 is for entire loan, right? For the entire 75%. No, so this 75% is actually the amount on the working capital, right? But on whatever amount you take, on that they will charge you 16.5. But from that they will keep it with them around 10% of the value. Value of what? 10% of the loan amount, right? Hence 100 minus 10% is what we have done. So this becomes 16.5 divided by zero point 0.9, 16.5 divided by zero point 0.9, 18.33%. Clear? So the right answer is 544,06250 and 18.33%. The last part, B part, is the right answer. Okay, 544,06250 and 18.33%. Clear, students? Okay. Yes, Pranjali, your answer is correct. Now, Sweetie is asking to explain the concept of bank loan. Okay, let me tell you. Let me go there. Okay, now what bank is saying? See, let's first of all see on these numbers. For example, our net working capital is 1 lakh. Okay, net working capital is 1 lakh. Now, bank is saying that I will fund only 75% of this 1 lakh. First of all, we are saying okay, that will become 75,000. On this 75,000, bank is saying that I will charge you 16 point how much percent? 16.5%. Okay, so this becomes how much? 75,000 into 16.5%. 12,735. Okay. However, at the same time, bank is also saying that in current account, I have to keep 7,500, which is 75,000 into 10%, right? So I am paying interest this much. And what is the available capital with me? Available capital with business is 75,000 minus 7,500, correct? Which is 67,500. Now, if you say the percentage of, or let's say percentage effective cost will be 12,735 divided by 67,500. So this will become how much? 12735 divided by 67,500. 75,000 into 16.5%. 123. Okay, this is, I have put it wrong here. This is 12375. Here it will become 12375 divided by 67,500 into 100. So this becomes 18.33 percentage. This is the same answer that we have calculated in the short manner here. Yes, Pranjali, you are right. I hope, sweetie, this is okay now. Are you able to connect? Clear, students? Should we move ahead? Sweetie, are you able to understand now? Perfect. Now let us move ahead. Now let us move to another question from RTP. So now let's move to question number 7. Yes. TQ Limited has commenced new business segment in 2023-24. The following information has been ascertained for annual production of 25,000 units, which is the full capacity. So this has material, and by the way, this is on the full capacity, right? So again, there is a catch. I will explain you while solving the thing. Material is 100, labor and variable overhead is 50, fixed manufacturing expenses is 35, depreciation is 15, selling expenses is 80% of variable, which is 10. In the first 2 years of operation, production and sales are expected to be as follows. If you see, 25,000 is the installed capacity, but the actual production and sales is given in year 1 as 12,000 and 10,000, then in year 2 as 18,000 and 19,000. The selling price is expected to be 250. To assess the working capital requirements, the following additional information is given, or we can say it is available. Okay. Now, what are the stock of materials is 2 months average consumption. Debtors is 1.5 months average sales. This is what debtors amount is. So 1.5 month is what we are supposed to give credit. Cash balance is around 50,000. Creditors for supply of materials is equal to 1 month's average purchase during the year. So the creditors are agreeing for a 1 month credit. Expenses, all expenses will be paid 1 month in advance during the year. Clear? Goods equal to 15% of the year's production in terms of physical units will be in process on the average requiring full materials, but only 40% of the other expenses. So they are saying that whatever is in WIP, you can assume that 100% RM is consumed in that, and only 40% of the labor and production overheads are consumed in that. Just to value that. The management is also of the opinion to make 10% margin for contingencies on computed figure and value the closing stock at the cost of production. Prepare for 2 years a projected statement of profit slash loss ignoring taxation and a projected statement of working capital requirements on a cash cost basis. That means they are asking us to exclude the depreciation. Okay, let's first move with the first requirement, students. So, in a way, for calculating, for presenting the projected statement of profit and loss, we will have to start with what we are going to produce, what we are going to sell, what is our likely to be sales, then what is the cost of production, what is the inventory in that, then what is the COGS. All those things we have to capture here. Okay. Sure. So let's start with question number 7. RTP May 2024. So this becomes the projected statement of profit slash loss. Okay. Now year 1 and year 2. So the production is how much? In number of units is 12,000 and 18,000. So that means next year production is going to be higher, which is fine. Sales again in terms of units is 10,000. So that means 2,000 closing stock of FG will remain at the end of year 1, because we are producing 12,000 but we are selling only 10,000. Clear? And against that, production was 18,000 and the sales is only 19,000. Sorry, it's higher now. So 1,000 closing stock will be utilized. The opening stock, which is the closing stock of year 1, will be utilized, and balance 18,000 we will produce and sell. Or you can say first in, first out basis, right? So now let's come to the sales revenue. This is coming on 250 multiplied by the units, respective units, right? So for example, this will be 250 into 10,000, and this will be 250 into 19,000. So this will become 47 lakh 50,000 students, and this will become 25 lakhs. Now let's come to the costs, right? Let's take cost of production first. The cost of production, if you see, comes from what all things? One is material cost. Now, if you see, whatever is the units produced, right, on that we are just multiplying with the material cost per unit. What is the material cost per unit? 100 rupees. 10,000 is, sorry, 10,000 the units sold. We have produced 12,000 units. 12,000 into 100. 12 lakhs. And here it is again 100 into 18,000, if I'm not wrong. This becomes 18 lakh. Okay. Then the next part will be direct labor and variable expenses. Okay. So this will be how much? So the labor and variable overhead is 50. 50 into 12,000, which is around 6 lakhs. And here is also 50 into 18,000, which is 9 lakhs. Now comes the catch, the one that I was talking about, fixed manufacturing expenses. Now, can anyone tell me what are the fixed manufacturing expenses? In the question, we have been given at the rate of 35. So, should I multiply 35 with the cost of the number of units produced, or what should I do? Come on, students, tell me. What should be the fixed manufacturing expenses? What should be the fixed manufacturing expenses? Anybody wants to attempt this? This is a very, a small trick in this. Not that it's not, I mean, because if you see in the starting part of the question, it is mentioned, let me open the question, that the below data is for the annual production of 25,000 units. So fixed manufacturing expenses is for annual one or what? No, sweetie. Again, please recheck. See, the fixed expenses is actually the fixed expenses is basically at the overall level. So it will be 35 into installed capacity, because the way fixed overheads amount per unit is calculated is we take the overall installed capacity, overall total amount, and arrive at the fixed manufacturing expenses. So 35 into 25,000, this is 8,75,000 in both the years. Okay, clear? Yes, VT, 875 in both the years. Perfect. Then similarly, depreciation also, students. Depreciation also will follow the same route. How much is the depreciation per unit? 25 into 25,000. Sorry, it's 15 rupees if I'm not wrong. Yes, it is 15 rupees. And here also 15 into 25,000. 3,75,000. So the overall factory costs becomes how much is the total? We can say gross factory cost 875 plus 375 plus 6 lakhs plus 12 lakhs, 30 lakh 5,000 in year 1. Sorry, 30 lakh 50,000 in year 1, and in year 2 375 plus 875 plus 9 lakh plus 18 lakh, 39 lakh 50,000 in year 2. So these are the individual costs that comes. Now since we are also talking about, so wait, now, so students, if you see, we have calculated here the cost of production, not the cost of goods sold. Now we have to arrive from this cost of production to cost of goods sold, right? So what we need to do then? We need to add opening WIP and less closing WIP, right? Whatever is work in progress, opening will get added and closing will get reduced, right? With that, we will come to know at the cost of goods produced. Now, first of all, here it is nil, right? And the closing WIP will be calculated with the help of a working note. Calculation of WIP, right? So let's calculate for year 1 and year 2. So year 1, we have raw material at the rate of, so we have raw material for the 100% amount, right? So what is the condition given in the question? Because it was mentioned that WIP 40% is for the other expenses and 100% for the raw material. At the same time, WIP is 15% of the production, right? So 15% into the material cost. Simply we can take that respective year's material cost into 15% will give us the result. What are the respective material costs? 12 lakh and 18 lakh. 2 lakh 70,000 and 12 lakh into 15% as 1 lakh 80,000. Clear, students? Now on the, okay, right, now on the labor and other manufacturing expenses, it will be taken at 40%, right? Whatever are the expenses, we will take at 40%. Labor and other manufacturing expenses, whether these are variable or fixed, we will take for everything. What are they? 6 lakhs plus 875 plus 375. 6 lakhs plus 875 plus 375, right? So in the year 1, it will be 18 lakh 50,000 multiplied by 15%, right? Because 15% is the WIP units multiplied by 40%, because within that only 40% is what it has been fulfilled. 40% into 15%. Okay. So this becomes triple 1,000. Okay. Similarly, here now we have 375 depreciation, 875 as the fixed expenses, plus 9 lakh as the direct labor into 40% into 15%. So this becomes 1,29,000. So let me put divide by 15%, divide by 40%. Yeah, so this was 21 lakh 50,000 into 15% into 40%, students. 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% 40% Yes, Bhumika, your answer is correct. How 25,000 unit? Where are you saying 25,000 unit? Kiran Bala, if you can revert here. Now, okay, you would have been responding. Okay, 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 got it. I understand, Kiran, now. So 25,000 is the installed capacity. If you see in this question, the opening part of the question says that the annual production of the units is 25,000. Okay, that is why we have taken the fixed expenses as 25,000. Now we have the WIP total amount, right? So this is 180 plus triple one, 2,91,000, and here it is 3,99,000. Clear? So we will put the opening and closing using those values. What is the closing value? 2,91,000. This will become the opening of next year, and the closing was 3,99,000. So add opening less closing, we arrive at the cost of goods produced. So this is 27 lakh 59,000, and this will be 39 lakh 39 lakh 50,000 plus 2 lakh 91,000 minus 3 lakh 99,000. So this becomes 38 lakh 42,000. Clear? Now in this we will add FG opening stock, and then we will reduce FG closing stock, and then finally we will arrive at cost of goods sold. Okay, I think this space will be a bit lesser. So let's first calculate the opening and closing stock adjustments. Closing stock. So if you see in year one, the difference between the produced units is 12,000 and 10,000, right? So 12,000 and minus 10,000, it's around 2,000 units is what we have extra produced and kept as a closing stock in year one. And in year two, only 1,000 units will remain as the closing stock. So for year one, 2,000 units multiplied by cost of production, which is, so let me write here the exact numbers. Let's say 2,000 unit is in the closing, right? 12,000 is for the cost of production. The overall cost is 27 lakh 59,000. So if you take this, the amount becomes 459,833. Okay, 459,833. Correct. So this will become now the opening stock, right? Now, if you want to follow the FIFO basis or average basis, both the methods will be fine here. So first of all, we have to find out that what is the cost of production for goods available for sale. This will be how much? The total of these two, right? In the year one, it will be same 27,59,000. In the year two, it will be 38 lakh 42,000 plus 459, 38 lakh 42,000 plus 459 833. So this will be 43,01,833. 43,01,833. This will become the COGS for the goods available in year 2, right? Now, in the year 2, we will be left with 1,000 units of goods, right? So 1,000. Now, if you see, what will be the closing stock? 842,000 divided by what is the count of the units produced? 18,000. So basis FIFO method, the answer comes out to be this much, 38 lakh 42,000, right? So 38 lakh 42,000 is the value of the goods produced during the year. For 18,000 units, out of that 1,000 unit is left, because we are assuming that 2,000 units, that was the opening stock, was sold first, right? So this is first in, first out, right? So this will become 213 triple four, and hence the cost of goods sold now will become, so this minus closing stock, right, which is 27,59,000 minus 45,98,33, 22,99,167. Then here it will be 43,01,01,833 minus 2,13,000 triple four. This is around 140 lakhs 88 389. So this is the COGS. Now in that we will add our selling expenses. So this selling expenses, as I said, it has two components, right? In the question it was given 80% is variable and 20% is fixed. Now again students, this 20% fixed, we will have to use the same catch. Yes, Bhumika, your answer is correct. Thanks for answering, Bhumika. Now what I'm saying is, for this 80% and 20%, we have to be careful. So for variable, this is 80% of 10 on number of units. What are the number of units sold? 10,000 in the year 1 and 19,000 in year 2, right? So 10,000 year 1, year 2, 80% of 10 on 19,000, right? So it becomes 19,000 into 10 into 80%, around 1,52,000. And here it becomes 80,000, right? Now fixed, it will be 2 into 25,000 at the full capacity, right? Whether it is produced, sold, it's not linked to the lower production or lower sales. Finally, the cost of sales becomes 80 plus 50 plus 2299 167. So this becomes 2429 167, and here it becomes 42 lakh 90,389. This is the cost of sales, and hence the profit slash loss is, if this is B and the sales number is here, which is A, so A minus B, 25 lakh minus 24 lakh 29,000. So this becomes 70,833. And in year two, the revenue was how much? Revenue was 47 lakh 50,000. So 47 lakh 50,000 minus 42 lakh 90,000, 389. So this becomes 459,611. So clear, students? This is now the first part that we have calculated. Okay. In the first part, they have asked us to calculate the. Let me again show you the question. So the first question was a projected statement of profit and loss. Now the next part, they're asking us to calculate the projected statement of working capital on cash basis. So this has one more twist. Okay, now the statement of working capital along with the cash basis we will have after 10 minutes break. Okay, so let's break for 10 minutes, then again we will reconvene on the balance part. Thank you. Sure. Yeah. So welcome back, students. In this question till now, we have solved for the first part. Now let us come to the second part, students. The second part is a projected statement of working capital requirements on cash cost basis. What do we really mean by cash cost? One, we have to exclude the profit margins, and second, we also need to exclude depreciation while we value our debtors or while we value our inventory. Till now, all the calculations, whether it is FG, WIP or debtors we have not done, but whatever we have done till now, we have calculated using the regular cost, which is including the depreciation. So we have to do now everything excluding depreciation. Okay, so let us start this working. So let us go to our solution page. So here now we are solving the second part. Okay. So the second part is calculation of the projected statement of working capital. Right. So how we are going to calculate this? Simple, right? For all the current assets, we will calculate the respective values. Similarly for current liabilities. So let us start with current assets first. We are talking about year 1 here and year 2 here, right? So in year 1, in current assets, we will go to inventories. Within inventories, let's first start with raw material. Now, raw material we are keeping as 2 months equivalent to the produced units. So 12,000 into 2 by 12 into 100 rupees. And similarly 18,000 into 2 by 12 into 100 rupees. Correct? So this becomes 2 lakhs year 1, and year 2 becomes 3 lakhs. Then we will come to WIP, work in progress. Now for this, let us do the calculation. So this is working note 2, calculation of work in progress. Why there is a need to do this separately? Because in the previous calculation, we have taken including depreciation. And in this part, they're asking us to calculate excluding depreciation or cash cost, right? So year 1, year 2, first of all, we have raw material cost, right? Which is the entire material cost into 15%, which is going to be the same. I'm just putting here material cost into 15% because 15% of the physical units are in WIP and 15% of the overall produced units are in WIP, and hence the overall cost of WIP The overall cost of material into 15% will become the raw material cost in WIP, 1,80,000 and 2,70,000. Now let come to the other part, labor and manufacturing overheads. Right now, for year one, let's go and see what was the labor and manufacturing overheads from this 6 lakhs and 875. We will ignore this depreciation as of now. Okay, I'm just removing these ticks so that later on all of you are not confused. So 6 lakhs plus 8 lakh 75,000 here. 6 lakhs plus 8 lakh 75,000. This becomes the total labor and manufacturing cost into 15% into 40% because they are currently at 40%, right? So this becomes 6 lakhs plus 8 lakh 75,000 into 15% into 40%, 88,500. For year 2, this will become 9 lakh plus 8 lakh 75,000. 9 lakh plus 8 lakh 75,000 into 15% into 40%. So 9 lakh plus 8 lakh 75,000 into 15% into 40%. So 1 lakh 6,500. So the total becomes 180 plus 88 500. 268 500. 270 plus 1 lakh 6,500. 376 500. This is the revised WIP cost. Clear? So we will put it here. 268 500 and 376 500. Now let's come to finished goods, students. In year 1, 2000 units are into finished goods, and in year 2, 1000 units are in finished goods. Working note 3, calculation of finished goods, right? So let us start with the gross factory cost that we had calculated. Gross factory cost as per the projected statement of P&L was how much? We're talking about this one, 30 lakh 50 and 39 lakh 50, both, right? From this, we will reduce the depreciation later on. So we are at 30 lakh 50 and 39 lakh 50,000. From this, let us reduce depreciation. Perfect. So I was just calculating this. 3,75,000 is the depreciation here, and 3,75,000 depreciation is here, students. Okay. So the cash factory cost is this much: 30,50,000 minus 3,75,000. So this becomes 26 lakhs 75,000, and this becomes 39 lakh 50,000 minus 3 lakh 75,000, around 35 lakh 75,000. Is the cash factory cost. And similarly in this, add opening WIP less closing WIP. So here it is nil. For year 1 WIP we have already calculated 268,500. Here also it will be 268,500, and less will be 376,500. I hope, students, this is you guys are able to understand. Students, let me know please if this is clear or there is something needs to be discussed. Please do let me know. Okay. So with this, we are at now 26,75,000 minus 268,500. So 240,6,500. This becomes the value 24 lakh 6,500. And here 35,75,000 plus 268,500 minus 376,500. So here the value becomes 34 lakh 67,000. This is cash cost of production. Clear? Now in this, we will add FG opening stock, and F, and here we will reduce less FG closing stock. Now for calculating the opening and closing, let's take for year 1 first. What is the cash cost of production? This much. This is for 12,000 units. For calculating it for 2,000 units, we will just simply take 24 lakh 6,500 multiplied by 2,000 divided by 12,000. So this becomes 2406 500 into 2,000 divided by 12,000. 401,083. 401,083. Here it is nil. Here the same number will become this much, 083. Okay. Then in year 2, this will be 3467 into, so this is for 18,000 units, right? and at the end of year 2 only 1000 units will remain as the closing stock. Clear, students? So now this will become 3467, 192,611. This will get reduced and the above one will get added. Okay, students, now this becomes the cash cost of goods sold. So this will be 24,06500 minus 401,083. So this will become 20 lakh 5,417, and here it becomes 34,67,000 plus 401,083 minus 192,611. 36 lakh 75,472. Okay, this is the cash cost of goods sold. Now coming back to our main statement. So finished goods, students. Now finished goods we have valued at finally these prices: 408 and 192,611. So this is 401,083 and this is 192,611. 401,083. Yes, perfect. Okay, so now the major chunk of this is now over. Now we have some simpler part. So this is all inventories, right? I'm talking about one here. Now let's come to for debtors, right? For debtors again, let's put a working note 3. Working note 3 was already there. Let's put a working note 4. This is relatively easy. Calculation of debtors. Now, while doing this debtors also needs to be calculated at cost, at cash cost, right? But as of now, in this cash cost of goods sold, the selling expenses are not added. So what we are going to do, we are going to take this and we are going to add the selling expenses. Cash cost of goods sold. This is year 1 and this is year 2. So this is 20 lakh 5,417 and this is 36 lakh 75,472. So in this we will add variable selling expenses as is, right, which is sales units multiplied by 8 rupees, right? Which is the 80% part. The above, whatever we have calculated, will get added as is 80,000 and 1,52,000. So here it is 8 for 19,000 units, which is 1,52,000. And then we will also add fixed selling expenses, which is 25,000 units multiplied by 2 rupees, because this is fixed. So students, please don't uh, make a mistake here by not including this. We have to include this. This is not depreciation. This is the fixed expenses, right? So 50,000 will get included, and another 50,000 will get included in year two, and hence the total cost, the cash cost of debtors will become this much. Cash cost of debtors will become 20 lakh 5,417 plus 20 lakh 5,417 plus 80,000 plus 50,000. So 21 lakh 35,417, right? And then in year 2 it will be 36 75 472 plus 152,000 plus 50,000. This will become 38 lakh 77,472 students. Clear? Now, debtors are at what period? They are, I think, 1.5 month the average sales. So we have to take 1.5 month for this. So debtors will be, so this is the annual cost, right? Debtors will be 1.5 month into the respective amount. So which is 21 33, 21 35 417. This is for year 1, and year 2 will be 1.5 divided by 12 into 38 77 472. 21 35 417 into 1.5 divided by 12. Okay, so this is 266 927, 38 77 472 into 1.5 divided by 12. So this is 484 684. The same numbers will get added in the above statement. For debtors, 266 927 and 484 684. Clear, students? Now let us go and see what all things are left in our working capital. See, we have completed inventories. In that we have calculated raw material, finished goods, and work in progress. Second, we have also done with the debtors. Now let us go to the what are the other assets. All expenses will be paid 1 month in advance. So there is a prepaid expense, right? So we have to also calculate in assets the prepaid amounts, right? Prepayment of expenses, right? Now let's calculate the prepayment of expenses. Working note 3, working note 4, working note 5. again for year 1 and year 2. Year 1 we have direct labor and variable expenses, right? And those two will be coming here. So direct labor and variable expenses, 6 lakhs and 9 lakhs. Then we will also have fixed manufacturing expenses around 8 lakh 75,000 and 8 lakh 75,000, right? But we are not going to add anything on account of depreciation, right? Now, we also have selling expenses year 1, year 2. On a cash cost basis, how much were they? 80 and 50 and 152 and 50, right? Clear? This will be 80 plus 50, 130. 152 plus 50 is 2 lakh 2,000. Now these all amounts are for the annual expenses we need it for 1 month, right? So let's add all of them. 6 lakhs plus 8 lakh 75,000 plus 1 lakh 30,000, 16 lakh 5,000, and here it will be 9 lakh plus 8 lakh 75,000 plus 2 lakh 2,000. So 19 lakh 77,000. So this becomes the total, and then per month amount is total divided by 12. Clear, students? So 16 lakh 05,000 divided by 12. This is 133,750, and the other one is 1977,000 divided by 12, 164,750. I understand this question is a bit bigger question because we have to first calculate the profit and loss, estimated profit and loss statement, then we have to calculate the working capital estimations. However, this question is giving us a lot of takeaways, right? One is the installed capacity of 25,000 vis-a-vis the fixed expenses. That is the biggest thing. Second is how to calculate the cash cost of debtors, cash cost of inventories, students, right? In case, and if any one of you have any, sorry, I think there was some issue. What I was saying is, in case if there are some any questions to be asked verbally, I request technical team to please unmute and so that the student can speak and ask the respective questions, right? Perfect. So just a second, I'm just checking the chat part as well if there is something. Perfect. Now the per month amount is this much. Hence, we will come back to our working capital statement and we will put those respective amounts 133 750 and 164 750. Clear? These are the prepayment of expenses. Now let's go to the question and see if there is any other asset that we are missing. The cash balance. Now we are missing the cash balance. How much is the cash balance? 50,000 for year 1 and year 2 respectively. So the total now comes out to be 2 lakh plus 2,68,500 plus 401,083 plus 266,927 plus 133,750 plus 50,000. So this becomes 13 lakh 20,000 to 60. And similarly for the year 2, now I am putting here total current assets as the name. Now students, please tell me from our previous session's discussion, what is the alternate name to this total current assets? If we have to say it by some other name of the working capital, through what other name we can call it? Come on students, tell me. The next year I'll just do the total quickly. 3 lakh plus 376 500 plus 192 611 plus 484 684 plus 50,000 plus 164 750. Yes. So this becomes 1568 545. Yes, very good, sweetie. Very good, Gunjan. Very good. Your answers are correct. So, but the other name that we can call to this is the gross working capital. Okay. Now, let's move to current liabilities. So, current assets are done. Now, let's move to B, which is current liabilities. Now, what are they? First of all, creditors, right? Creditors are there for the current liabilities. Let's go and prepare a working note because in this we are going to purchase, we are going to link it with the raw material purchased, right? So, working note 6. This is for the calculation of creditors students, right? Now, for creditors, let's first calculate that how much raw material are we going to purchase, right? So let's start year 1, year 2, raw material consumed is 12 lakhs worth of amount and 18 lakh worth of amount, right? This is what you have consumed as your raw material. In that, let's add the closing stock of raw material that we are keeping. That is the 2 months closing stock, which is this amount. In our statement, this one, 2 lakh and 3 lakh. Okay. So this is 2 lakh and 3 lakh. Okay. However, in this 3 lakh, in year 2, there is a opening stock also that is sitting, right, of 2 lakh. So that also we will reduce. So first of all, add closing stock, then less opening stock. Here it is nil and here it is 2 lakhs. Then purchases during the year will come, right? So 12 plus 2 becomes 12 plus 2 lakh becomes 14 lakh. And here 18 plus 3 minus 2, so 19 lakhs becomes our purchases. So the average creditors are for how many months? Students, it's 1.5 month if I'm not wrong. No, 1 month. So 1.5 was for debtors. So this is 1 divided by 12 into 14 lakhs. And here it will be 1 divided by 12 into 19 lakhs. Okay. So 14 lakhs divided by 12, which is double one six 667. Okay. And here 19 lakh divided by 12 is 158,333. Let's use these amounts in our working capital. So here it becomes double one six 667, and here it becomes 158,333. Okay. So these becomes our creditors in our final statement. So the total, is there anything more in the current liabilities? No, because all the expenses are prepaid, right? So they have moved to the asset side. So current liabilities, we have nothing now. So double one six 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 seven and 158,333. This becomes our current liabilities, and hence the net working capital becomes, if let's say this is A and this is B, so we are talking about A minus B, so which is 13 lakh 1320 260 minus double one triple six seven. So this becomes 1,20,000. Sorry, not 1 lakh, 12 lakhs. Still I can write 12. Wait, 12 lakh 3,594, and here it becomes 1568 545 minus 158 333. So this becomes 14 lakh 10,000 212. Very good, Bhumika. Thanks for the answers. Yes, Gunjan. Current asset minus current liability. Okay, Gunjan, I will try to give it in Hindi. Clear then, finally, this net working capital is this much. However, in question, there was one more thing. It is also mentioned that in the last para I am reading, the management is also of the opinion to take 10%, to make 10% margin on contingencies on computed figure. Okay, and value the cost and value the closing stock at cost that we have already done. So in this, we will just add our contingency margin at the rate of 10%. Okay, so 10% of what? 10% of these amounts. So here it will be 10% on 12 lakh 3,594. So which is 1 lakh 20,359, and here it will be 1 lakh 41,021. Okay, and we are going to add this to arrive at the overall working capital required. So this becomes, if we add this 120,3594 plus 120,359 13,23953, and here it is 1410,212 plus 141021 1551233 1551233. This is it. This is the estimated working capital required. Okay, clear, students? Although it was a very big question, but was having a lot of things to understand and to do the solution accordingly. Okay, students. Now let me see. I think one small question we can do. Yes, so let's go to question number one from the study material in the practical assignments. Okay, let me just move it. And let's go back to the working capital and our chapter. I'm going to question number one from the practical assignments. Yes. The following information is forecasted by R Limited for the year ended 31st March 2022. They have given us the balance sheet, current year, last year, raw material, work in progress, finished goods, receivables, payables, annual purchase of raw material, all credit. So they are saying everything is on credit. Annual cost of production, annual cost of goods sold, annual operating cost, and annual sales, and they are all credit. You can take 1 year as equal to 365 days, is what they are saying. You are required to calculate the net operating cycle period, number of operating cycles in the year. So see student, now this is a different type of question and hence I have taken this. And finally the amount of working capital requirement. Now what is the operating cycle period, students? Operating cycle period is what exactly, students? Operating cycle period is your whatever cycle of current assets minus current liabilities, that becomes your operating cycle. So let us quickly find out first of all the number of days for all of these values that has been given to us. It's a very easy and simple question. So question number 1, this is practice questions. Okay, now let's calculate the number of days quickly for all these values that are given. So raw material, number of days we will calculate how? See, now we will take the average stock of raw material, right? Which is opening plus closing divided by 2. 45 plus 65 divided by 2. This is the average stock of raw material. What is the average consumption? Average consumption that is given in the question is 380, right? Multiplied by 365. So this gives us 53 days. Okay, students, I'm just putting it, just a second. Yes, so this becomes 53 days. Now, after raw material, we have, okay, how have we calculated the annual consumption of raw material, students? So that can be calculated by, we will take opening plus purchase minus closing, right? Then you will be able to arrive at the final number. So opening is 45. What is the purchased amount? 400 minus 65. So this gives us 380, which we have used above. So this is for raw material. Similarly for WIP, WIP again average divided by annual cost of production. Average WIP divided by annual cost of production, again into 365, right? So this comes out to be 35 plus 51 divided by 2 whole divided by the annual cost of production, which is given in the question, 450 into 365. So this is 35 days. Clear? Then FG is again average FG divided by COGS. Average FG stock divided by COGS into 365. Clear? So this becomes 60 plus 70 divided by 2 whole divided by 525 into 365, which is actually 45 days in the rounding off. Clear? Then lastly, after FG, we are left with receivables. Again, for receivables, average receivables divided by annual credit sales. So this is 112 plus 135 divided by 2 whole divided by the average credit sales of 585 into 365, which is equal to 77 days. Clear? Now, lastly, we have payable days. Again, the credit purchases will be in denominator and numerator will have average payables. So 68 plus 71 divided by 2 whole divided by average annual credit purchases, which is 400 into 365. So this gives us 64 day, students. Now let's come to the requirement. The first one, net operating cycle This will be raw material plus WIP plus finished goods plus debtors minus creditors, right? So let's take all of them. 53 plus 35 plus 45 plus 77 minus 64 is equal to 146 days. This becomes the net operating cycle. The number of operating cycles in a year. So 365 divided by operating cycle period, right? Number of operating cycle in a year. So this is 365 divided by 146, which is 2.5 times. So in a year, 2.5 times the operating cycle rotates. And finally, the amount of working capital required will be annual operating cost of 325 divided by 2.50, which is 130 lakhs. Simple. Okay. Now there is a request from Gunjan Kumar to please discuss in Hindi about the summary. So I will explain in Hindi, although we are not allowed to do so because we have to keep in mind for everyone, but still. सो बेसिकली अभी तक हमने जो पढ़ा इसमें वर्किंग कैपिटल की मैनेजमेंट के ऊपर हमने सारी चीज़ें पढ़ी हैं, जिसमें कि सबसे पहला काम ये समझा, सबसे पहला कॉन्सेप्ट ये समझा कि वर्किंग कैपिटल का मतलब क्या है। वर्किंग कैपिटल का मतलब है करंट एसेट्स माइनस करंट लायबिलिटीज। अब उसमें जो ये टर्म है करंट, उसका मतलब ये होता है कि जो आगे आने वाले 12 महीनों में सेटल हो जाए इन अ वेरी प्लेन लैंग्वेज, या फिर ऑपरेटिंग साइकिल के अंदर सेटल हो जाए, वो होता है वर्किंग कैपिटल। अपार्ट फ्रॉम वर्किंग कैपिटल हमें जरूरत पड़ती है कैपिटल एक्सपेंडिचर की। कैपिटल एक्सपेंडिचर वो होता है जो प्रॉपर्टी प्लांट एंड इक्विपमेंट और फिक्स एसेट्स में यूज होता है, ठीक है। एंड क्योंकि ये चैप्टर वर्किंग कैपिटल से रिलेटेड है, इसलिए हमें वर्किंग कैपिटल के ईच एंड एवरी कंपोनेंट पे ध्यान देना है। फॉर एग्जांपल इन करंट एसेट्स हमारे पास है इन्वेंट्री फॉर RMPM, FG एंड हेंस डेटर्स ऑल्सो, और उसके अलावा अगर कुछ प्रीपेमेंट है तो वो, और लाइबिलिटी में आ जाएंगे क्रेडिटर्स एंड क्रेडिटर्स और ये अपने एक्सपेंसेस पेबल्स। ओके। नाउ अब वर्किंग कैपिटल में सबसे बड़ा काम ये है कि हमें एस्टिमेट करना है। कोई भी नई कंपनी खुली है या कोई भी एग्जिस्टिंग कंपनी है, उसको कैपिटल नीड्स के लिए एस्टिमेट करना है वर्किंग कैपिटल कितना होगा। उस एस्टिमेशन के लिए हमें सबसे पहले ये सोचना है कि हमारी सेल्स कितनी होगी, हमारी प्रोडक्शन कितनी होगी। जितने भी क्वेश्चंस आज हमने सॉल्व करे हैं उसमें वो सब चीज़ें डिस्कस करी गई हैं कि आपको कैसे एस्टिमेटेड कैपिटल की, वर्किंग कैपिटल की जो है स्टेटमेंट प्रिपेयर करनी है। अब इसमें दो तीन कैच हैं। सबसे पहला कैच तो है कि डेटर्स हमेशा हमें कैश कॉस्ट पे लेने हैं। अगर क्वेश्चन ने स्पेसिफाई करा था तो लेने ही लेने, अगर नहीं करा तो भी आप ले सकते हो और सॉल्व कर सकते हो। और दूसरा इन्वेंट्री, इन्वेंट्री भी हमें कैश कॉस्ट पे लेनी है, ठीक है। मोस्टली नाउ आई विल कम बैक टू इंग्लिश। आई वॉज इन हिंदी बिकॉज वन स्टूडेंट हैज रिक्वेस्टेड। Now, just to say, see, all the questions are very much unique in working capital, right? We cannot limit ourselves to the discussion of only these two, three questions that we discussed today, along with the previous session questions that we have discussed in the previous session. This is more on logical bit, right? Hence I request every one of you to be please more logical, to read the question properly, to make use of the facts in the given question, and hence you can solve it accordingly. Okay. So I think this was all from my end. Although there we completed three questions, but those were very technical, very big, and very exhaustive questions, right? So I would request all of you to please do the revision well, and all the best for your preparation and examination. Okay. So thanks a lot. Thank you, everyone. Technical team. Yes.
Thank you, sir.